Micron dropped 4.7%. Lab scores at 75, strong buy. While the market frets over cyclicality, Micron remains the sole domestic supplier for HBM3e modules that deliver a 30% power efficiency lead for Blackwell chips. This hardware bottleneck ensures high-margin dominance as AI demand outstrips current fabrication capacity. We are breaking down why this dip ignores a massive structural supply advantage today. Micron's 1.2 terabytes per second, the speed data travels between memory and the processor. Bandwidth on its HBM3e stacks is a decisive competitive strength that renders today's 4.7% price drop irrelevant to the AI build-out. The lab is focused on the 1-beta process node, the manufacturing generation that utilizes advanced multi-patterning lithography to achieve superior bit density. This specific architecture allows Micron to achieve 30% lower power consumption compared to SK Hynix's HBM3e, which is critical as data centers hit the TDP wall, thermal design power, the maximum heat a cooling system can handle. While SK Hynix holds a 12-month volume lead, Micron's engineering focus on joules per bit efficiency is the only way to scale high-density GPU clusters without exceeding rack power limits. Despite the market panic driving the price to $891.88, the physical reality is that Micron's HBM capacity is fully booked through 2025. We are seeing double-digit growth in ASP, average selling price, the price per unit sold, because the industry has hit a structural supply ceiling on leading-edge 1-alpha and 1-beta nodes. The bottleneck isn't demand, it's the reticle limit, the physical size constraint of the mask used to print circuits on a wafer, which restricts how many HBM dies can be harvested per silicon slab. As the market prices in geopolitical risk, it ignores the fact that Micron is the only player scaling domestic advanced packaging, the tech used to stack and connect chips vertically, in its New York fab. The engineering bottleneck ensures that Micron's margins remain protected regardless of macro volatility. Quarterly financials showing modest revenue momentum for Micron. By Q4 2026, escalating trade protectionism will compress Micron's valuation multiple by 15% as the Trump tariff narrative forces a structural repricing of the global semiconductor supply chain. While the Fed maintains a 3.63% rate and CPI, the Consumer Price Index, measuring the average change in prices paid by consumers, sits at 0.6%. The real friction isn't domestic inflation. It is the cost of capital in a normalizing yield curve environment where the 10Y yield of 4.53% makes Micron's massive capex. Capital expenditures, the funds used to acquire or upgrade physical assets, more expensive to finance. Despite revenue growth of 196.3%, the lab sees a policy-driven shift. The CHIPS Act funding is now a geopolitical tether, requiring Micron to build domestic advanced packaging capacity that costs significantly more than overseas alternatives. The market is currently reacting to an Iran threat, but the deeper wave is the structural decoupling of high-end silicon. Micron's 2.17 beta, a metric where a value over 1.0 indicates higher volatility than the S&P 500, means it absorbs double the shock when global stability fractures. With recession risk at 6.8%, the lab is tracking how sovereign AI mandates are replacing open trade. This shifts the engineering burden from yield optimization to regional redundancy. As management pivots from discussing EPS growth of 756% to discussing supply chain resilience, they are signaling that the era of just-in-time memory is dead. The social backlash against big tech's energy consumption is further tightening the screws as cooling high-density memory racks becomes a regulatory target. Geopolitical friction has officially outpaced engineering efficiency as the primary driver of Micron's bottom line. Micron reported earnings per share of $12.20, beating the Wall Street estimate of $9.58 by 27.3%, a solid beat that signals strong execution. Micron memory is trending higher at $891.8. Management's headline this quarter: Micron advances New York chip project. Three words that appear in every press release, investor slide, and CNBC cheering. Designed to make you feel the CHIPS Act is working: jobs, sovereignty, margin expansion. Designed to make you not think about the 160,415 shares insiders net sold in the last 90 days. That's not a liquidity event. That's a pattern. When executives sell that much, that fast, it historically precedes a margin reset or a node transition stall. They're not timing the bottom. They're timing the reality that HBM3e yield curves are flattening at 3 nanometers, and every incremental fab dollar buys less gross margin than it did last year. The official story is CapEx as growth. The lab hears CapEx as compensation for geopolitical friction, for CoWoS reticle shortages, for the fact that Micron's New York fab won't hit volume until 2028, and by then, TSMC's 2 nanometers will already be shipping. R&D is up 10.7% YOY, but as a percentage of revenue, it's still 10.2%, unchanged. That's not conviction, that's maintenance. They're not betting bigger on the next node, they're protecting the current one. And while Wall Street cheers the 27.3% EPS beat, the real signal is buried in the 10Q. Inventory days rose 12% sequentially. That's not demand, that's buffer for a supply chain that's about to get a lot less global. Last quarter, the earnings call script said record HBM demand. This quarter, it's prudent inventory management. The momentum breakdown for Micron: RSI sits at 60, pointing to bullish momentum with buyers in control. MACD is currently bearish, with downward histogram pressure. Micron is the only domestic player riding the HBM3e high-bandwidth memory feeding AI processors wave with Nvidia's Blackwell. Their transition to monolithic 32 gigabits DDR5, a single-die memory chip with double previous density, offers power efficiency gains over SK Hynix. At a forward PE of 8.0x, the market is discounting this structural shift. But here is what breaks the bull thesis. Micron is fighting a two-front war. While HBM3e yields, the percentage of functional chips per wafer, are improving, any slip in EUV, extreme ultraviolet lithography for sub-10 nm features, integration stalls their 12 high stack roadmap. If standard LPDDR5X inventory gluts return, high-margin AI wins won't offset commodity bleed. The question that makes the room go quiet: can Micron scale HBM4 samples faster than incumbents while managing the thermal density of 12 high stacks? The lab's answer is in the packaging. By using CHIPS Act subsidies for domestic facilities, Micron is bypassing offshore bottlenecks. They are selling a sovereign supply chain. This reduces geopolitical friction, the risk of cross-border trade, which is the real margin protector. We issued a strong buy at $949.28 on June 8th. At $891.88, we are down 6% as the wedge pattern consolidates. If Micron clears HBM4 qualification by late 2026, expect a retest of $1,079.57 resistance. If standard DDR5 inventory swells before Q4, we likely retreat to $681.54 support. Our AI score of 75 out of 100 reflects conviction that the HBM3e ramp will overwhelm commodity weakness. Watch the 12 high stack yields. They are the lead indicator. Nvidia dropped 3.7%. Lab scores at 58 out of 100. Hold. While analysts focus on software moats, the actual bottleneck is the CoWoS packaging. This local silicon interconnect doubles throughput, yet supply chain constraints on these physical substrates limit immediate upside. Our teardown reveals why Blackwell's engineering complexity makes this current dip a technical trap rather than a discount. Nvidia's market dominance is hitting a physical ceiling at the 8.0 terabytes per second, the measure of how much data a processor can access from memory every second. provided by the Blackwell architecture. While the market fixates on the 3.73% price drop to $200.42, we are focused on the CoWESL, chip-on-wafer-on-substrate, with local silicon interconnects, the advanced packaging technology used to fuse two massive dies. This packaging is the primary bottleneck because it pushes the reticle limit, the maximum physical area a lithography machine can expose on a single silicon wafer. AMD's MI300X cannot match Nvidia's 1.8 terabytes per second NVLink, the high-speed interconnect that allows multiple GPUs to communicate as a single unit, which is why Blackwell remains the gold standard. The lab sees a clear divergence between Nvidia's $4.9t market cap and its 12.6% underperformance against the XLK, a popular technology sector exchange-traded fund, over the last 30 days. This lag isn't about demand. It is about the TDP, thermal design power, the maximum amount of heat a chip generates that a cooling system must remove, which has reached 1,200 watts per Blackwell GPU. This power wall forces data centers to transition to liquid cooling, creating a deployment lag that Wall Street misinterprets as a slowdown. We are tracking the 3.63% Fed rate and normalizing yield spreads, but the silicon reality is that supply is capped by packaging yield percentages. Today's dip below the $217 20-day moving average reflects the market finally pricing in these persistent physical constraints. Quarterly financials showing modest revenue momentum for Nvidia. By Q4 2026, the escalating friction of localized fabrication will compress Nvidia's gross margins by at least 150 basis points. While Wall Street fixates on the 85.2% revenue growth, the real story is the cost of capital. With the Fed rate at 3.63% and the 10-year yield, the interest rate the U.S. government pays to borrow money for a decade, at 4.53%, the discount rate for future AI earnings is rising. Fed officials are now putting rate hikes back on the table despite CPI, the Consumer Price Index, which tracks inflation, sitting at 0.6%. This monetary friction hits Nvidia's 2.20 beta, its volatility relative to the S&P 500, like a hammer. Simultaneously, new tariffs are transforming from political rhetoric into a structural tax on the silicon roadmap, forcing a costly pivot towards sovereign AI infrastructure. The geopolitical landscape is shifting from trade friction to a total hardware decoupling. Markets are plunging as trade war fears over Greenland and renewed tariffs threaten the global supply chain. For Nvidia, this means the engineering reality of CoWES, chip-on-wafer-on-substrate, the advanced packaging that determines how many AI chips can be produced, must be localized to avoid export controls. This move toward domestic fabrication is a margin killer, even as EPS growth, earnings per share, a key measure of profitability, sits at a staggering 214.5%. Socially, the narrative has moved from AI wonder to national security necessity. This political pressure is the ultimate bottleneck. While the yield curve is normalizing, signaling a lower 6.8% recession risk, the macro environment is no longer a tailwind. It is a physical constraint on the silicon frontier. Nvidia reported earnings per share of $1.87, beating the Wall Street estimate of $1.79 by 4.3%, a solid beat that signals strong execution. Nvidia Compute is trading below its 20-day average at 200. Segment 3, the PR Insider Filter, Nvidia management's headline this quarter. We're working to hold gross margins in the mid-70s. That's the phrase they want you to remember: stable, predictable, resilient. What they don't want you to ask: what's the cost? Colette Kress's answer to Stacy Raskin was a masterclass in deflection. Input prices that are well known in the industries, without naming a single one. Memory, packaging, TSMC's 3nm N3e yield curve, silence. Meanwhile, insiders net sold 1.6 million shares in 90 days. That's not confidence, that's a liquidity event. When executives sell at a 4Q beat streak, they're not betting against the stock, they're betting the cost curve is about to bite. EPS beat by 4.3%? Irrelevant. The trend is R&D surging 43% YOY to $18.5 billion, 8.6% of revenue. That's not efficiency, that's desperation. Blackwell's die size, 2000 superscript 2, and HBM3e bandwidth, 1.8 terabytes per second, don't scale linearly with cost. Every extra watt of TDP requires more CoWoS reticles, and TSMC's yield on those is still below 70%. Management calls this innovation. The lab calls it a margin cliff dressed as a capex holiday. Watch for R&D as a percent of revenue to dip below 8% in the next 10Q. If it does, the thesis cracks, because the only thing holding margins in the mid-70s is burning cash to outrun physics. The momentum breakdown for Nvidia. RSI sits at 33, pointing to neutral zone, waiting for a clear directional signal. MACD is currently bearish, with downward histogram pressure. Nvidia's dominance isn't software. It's Blackwell and CoWoS, chip-on-wafer-on substrate with a local silicon interconnect that doubles throughput. GB200 NVL72 systems force hyperscalers into a liquid-cooled hardware lock-in. They aren't just buying chips. They are buying the only thermal architecture capable of running trillion-parameter models at scale. But here's what breaks the bull thesis: hardware monetization friction. If big tech's capital expenditure, the massive spending on infrastructure, fails to generate software revenue, the Blackwell ramp stalls. Furthermore, trade protectionism creates a margin trap. Designing lower-spec H20 variants for China wastes engineering cycles on silicon that yields lower ASPs, average selling prices. The question management fears: is the engineering cost of bypassing export controls now exceeding the returns from China? The lab's answer: yes. Nvidia is burning R&D to lobotomize its own silicon. While the street eyes the $310.89 price target, they miss how regional fragmentation destroys architecture efficiency. Geopolitical friction is now a permanent tax on silicon innovation. The lab issued 3 buy signals since June 4th above $205, with the price at $200.42. Those calls are currently underwater as we await a confirmed floor. If Blackwell production hits full scale by early 2025, Nvidia targets the $235.47 resistance. If big tech slashes capex, expect a breakdown to the $199.25 200-day moving average, the average price over the last 200 sessions. The lab's call: our 58-100 score reflects a cautious hold until the RSI, Relative Strength Index, clears 33.2 and confirms support at $200.42. Microchip maker MU just earned a 75 strong buy score. Are you holding MU right now? Drop your entry price in the comments. Let's compare levels. Remember, this is not investment advice. It's purely educational. Do your own research before acting and understand that past performance is no guarantee of future results. Markets shift quickly, and any single metric can be misleading, so verify sources and align with your risk tolerance. Subscribe so you don't miss Thursday's deep dive. We're tearing down ASML. Stay sharp and keep building.